Good morning, good afternoon, or good evening, and welcome, depending where you are on the planet. Good morning, good afternoon, or good evening. Welcome to the Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome. You on there live, Richard? Richard 87. I'm guessing that's your birth year, Richard. So a little bit younger than me. Bull versus Bear webinar. I've lost my thread now. Monday, the 5th of June, 2023. Welcome, everyone. We're going to go for our usual regular run through here for a Monday, which is kind of slightly different to the normal run through. And then I'll take a look at what I like to call the shape of the week. So, yes, I know we are day trading here at Trade Day, and that's the whole idea. But equally, I've done this since I've been in the markets for over 30 years. I think it's really useful to take a look at the whole week in here because, you can get a sense of whether the market's going to be busier maybe earlier on in the week or later on in the week, given if you see the where the volatility points are potentially going to be. If you've got a load of events in the, say, second half of the week, then the beginning of the week's likely going to be a little bit quieter, a little bit less volatile, maybe a mean reversion day. It's good. Look, we're getting a bit of interaction. I like a bit of interaction. Morning, Richard. Morning, Greg. Morning, Jack J. Please put hello, good morning, or whatever into the chat if you would like to. Where was I? Shape of the week. It's important to have an understanding, even though you're day trading, right? And you should know when these data points are coming up. Gives you a good idea. Certainly within the day, you should know when the data is. So what I'm going to do first of all, you've got the calendar in here. Now, remember, this is in the trading room. You've got this calendar. You can also click here and go to the CME's own calendar. So we've got the investing.com, which is a very thorough calendar in here, and the CME's calendar in here. Let's go and take a look, though, what I've downloaded. So now this is available from the members area. So if you go into the member trading room into the trading room. I'm not going to go into trading room because obviously that's where I'm live streaming. So we get a load of feedback of me talking if I go into the trading room. But you can go into the trading room. And within that trading room, you can then see the part where there's the research reports and there's the daily technical reports in there. But you also get this in here. This is the recap, the weekly recap I put up. But then also in here, if I jump through to here, there's a much more in-depth report in here that goes up. Now, you can access this through here. So you go in here, resources, trading advice and tips blog. So I'm going to open that in a new tab and we go to here. Okay, trading advice and tips blog, click here, and then it's in here. You can also get it back from the bottom of the trade day. So click here, and it's going to open it up, and then you've got all this. So this goes up. So there it is, the macro matters. This goes up once a week, usually at the weekend. This is a far more in-depth look. So I'm not going to go through in that because it goes into a lot of in-depth in here, about Fed, debt ceiling. It's got US, talking about payroll, talking about ISM, volatility, goes into Europe and the PMIs, Asia and China, commodity markets. So it's a real in-depth, and then it's got the end in here, the calendar, and it's just pulled out in here the bits that I think are the more important. So there's a lot of depth to that. Now that's kind of summarized in the bit that we get in here. If I can finally get back to it in here, this summary. Okay, so just in bullet point form. So let's take a look through that in here, what we've had. Morning, Brandon, as well. Brandon, thanks for saying hi. So in here, risk on with debt ceiling raised and positive US employment report. Risk on. Remember, risk on. Traders, investors willing to take more risk. Okay, think of it like you're at the casino, putting chips on the table rather than taking chips off the table. Risk on, taking more risk. Okay, so it's not that it's a more risky scenario. Okay, it's actually traders, investors taking more risk onto the table because they're more confident, and so stocks go up. Bonds usually, not always, go down, and then risk off the opposite of that. Okay, so debt ceiling raised, positive US employment report. So let's have a real quick. So we know about the debt ceiling in the rear view mirror now. Market took a relief from that, and we saw the market push higher through the middle of last week. Fed speakers last week, we had both Harker and Jefferson. Harker's a bit more in the center, Jefferson a little bit more of a hawk, and we go, and how do we know that? Well, again, go to the back to all of these in here, and if you go into here, there you go, the FOMC hawk and dove sheet. Maybe bookmark this one, guys, right? And then I've got it bookmarked and I've written it, but here it is, the FOMC hawk dove sheet in here. So who do we have? Jefferson, you can see more in the middle. Harker, a bit more of a dove. So Harker, definitely a dove. So a dove saying something dovish, not a big deal. Jefferson is more centered to, I'd say he's actually a bit more down here now, maybe even. So these positions come from ITC ITC Markets, actually. It's a research boutique that I have an association with. So these are their. This is my opinion. This is where the research boutique ITC Markets in here, where they think these guys and ladies how they measure up as hawks or doves. But so Jefferson in here, but certainly either to centre to, I would say, slightly more on the hawkish side. And what did they say last week? We'll jump in, skipping around a little bit in here. But I'll get there in a second. So they were both, if anything, slightly dovish. Harker, time to at least hit the stop button regarding the June meeting on June the 14th, and then more of a hawk. Jefferson in here spoke the potential to skip a rate hike in June. So certainly a slightly more dovish tone coming through there, and that was definitely reflected in the CME tool in here. And then we're seeing this push higher. So this is the unchanged. This has been pushing higher through last week in here. So now 77% chance we stay as unchanged. Only a 23% chance we get a hike. But the market is pricing in only a pause, because if we look here into July, we now see the risk of a hike that's in here is 50% risk of really a hike. And then it's almost even Stevens, whether hike or unchanged, right? So there's not a lot in it between do we go more, but actually the market is probably more pricing in a hike, right? Because it's actually pricing in nearly 14% of a 50 basis point. So you add these two together, you got like nearly, what's that, 68, 69%, and only 31% that we stay unchanged. So the market is expecting a pause in June and then a hike in July. But nevertheless, there's a slightly more dovish shift than we'd previously seen. And then so stocks like that. And then they like what they liked even more on Friday. If I can go back to the right tab, in here was the US employment report. Now, importantly, it wasn't just the headline number. The headline number beat the expectation number by 144,000. But we also had upward revisions from the prior 2 months of a total of 93,000. So the combined of the last 2 months revisions higher, plus the fact that we were higher than the expectations, mean that compared to the previous and the expectations, we actually added nearly 250,000, 237,000 jobs more than than was expected from the data. So then obviously the market actually liked that. The market saw that as a real positive. Importantly as well, you might look at that as, previously, maybe 6 to 9 months ago, we would see a strong jobs report as being a negative because of the upward pressures on wages and the upward pressures on prices. Okay. However, two things. One, prices are coming under control. Prices are falling. Inflation is coming under control. The rate hikes that we've seen from the Fed are doing their job. Secondly, though, as well, look at the other thing in here. So not only we've that the unemployment rate actually went higher, and it can do that, right? We can actually add in jobs and the unemployment rate went higher. So the unemployment rate went slightly higher. So that's actually meaning in some ways still a strong jobs market, but slightly loosening as well. And so that's probably positive because we want the job market to not be so tight. But also, look, average hourly earnings dipped and wage growth fell. Okay, and those are positive. Okay, the Fed will like that, right? So because then that's less of an upward pressure on wages, less of an upward pressure on prices. So that is seen as like you kind of got positives in that the fact that the economy. The jobs market stays strong. People are adding in more jobs being created. So that's showing a strong economy, but also then average hourly earnings and wage growth are falling. So that's encouraging for the Fed. We also had US ISM manufacturing data, which was slowing and showing growth slowdown. So that was a little bit of a concern, particularly as we'd already had two sets of Chinese PMI data, which looked a little bit worrying as well from last week. And I've got a little note on that, so oh, no, that's the wrong one. It's this one here. So Morgan Stanley joined Goldman in cutting China index highs. Now, they're still bullish. Okay, they're still bullish, but they've cut the upside targets on the Chinese indices in here. But they maintains overweight call as markets resume outperformance. So they're still looking for it to be strong, but they've cut their actual index targets and likely on the back of that data. So just wanted to mention that in there as well. What else do we have in here? So what do we have? We saw stock indices leaping higher, NASDAQ and the S&P. Now, I've got one on that, which is kind of quite interesting. That's not the right article in here. It's going to be along here somewhere. This one here. So Wall Street week ahead, surging US mega cap stocks leave some wondering when to cash out. So the issue in here is that, we know, right? You're trading this every day. A lot of you looking at the S&P and NASDAQ. The NASDAQ has been the leader, right? Growth stocks are doing well. Big tech is doing really well. AI driven boom. Nvidia became a $1 trillion company at one point last week. So all of that we know, okay? But the worry is this: if you've missed this kind of data, the rally has been quite narrow. What do we mean by the rally being narrow? It's located in a smaller number of the stocks than we would like. What we really want to see, if you want to see a sustainable rally, okay, you want to see breadth. Okay, so you want to see a broad rally. All stocks doing really, really well. Okay, the worry here is, look, a record 8.5 billion flowed into tech stocks in the latest week, data from the Bank of America Global Research. So a lot of it's going into tech, okay? And then also looking here, look, into a rally that's seen the tech-heavy NASDAQ gain 33% in 2023. That's a little bit of a return compared to the S&P 11.5%, okay? But then also in here, look at the breadth. Yeah, obviously reason for caution. Among them is the narrowness of the market's rally. The 5 largest stocks in the S&P. Remember the S&P 500 is it's not just a clever name. The 500 is 500 stocks. Just the top 5 in here. So the likes of your Amazons, Apples, etc., Googles, right? All of those are driving the market higher. And those in here, sorry, one sec. I've got just something popping up you probably can't see on the screen. But right, they have a combined weight of 24.7. 5 stocks of 500. 5 stocks of 500 make up nearly a quarter of the whole S&P 500 index, okay? And that is at its highest level as a percentage. That those 5 stocks making up that amount, that is at the highest level since 1972. That's a concern. It shows it's a very narrowly driven rally, given that how much of a percentage they make up, this huge percentage just amongst the top 5 stocks in here. So this is a little bit of a worry for that NASDAQ-driven, broader tech-driven, not a tech-driven rally rather than a broader rally. What have we seen in here overnight? So I'm going to just shift in here away from what we've had. Actually, let's just go and look at what we've got coming up. So data is fairly light this week. You know, the real highlight we've got coming up today, we've already had European and Asian data from S&P Global on PMI, manufacturing and composite PMI. It's all been a little bit disappointing, particularly out of Europe. Later on, we get the S&P Global data from the US, but the more of the focus is on that ISM data. That's going to be the big focus today. We also get US factory orders coming later today. We get 2 central banks in play. Reserve Bank of Australia and Bank of Canada. They are on Tuesday and Wednesday respectively. Other than that, data is light. If you look at the US data in here, US jobless claims, that's not really a biggie in here. China CPI, PPI, Canadian unemployment. There's the real US data is focused on this PMI data and factory orders today. That's the big data for the week. The other thing to note is the Fed. You remember the blackout period? Here's the Fed talking. I'm going to share this in here. You know what? I'll throw in the where is it? The macro, the Hawk Dove sheet in here as well. Sorry, I'm going to throw. These are all going up into the chat. I hope you can see these popping up in the chat. By the way, guys, and obviously I never get to watch my own webinars. So do they pop up live when you're in the chat at the bottom? I'm putting them in the chat now. I'm also going to put in the macro watch in here. Oh, where's the macro watch? There's the calendar. There's the macro. Sorry, not the macro watch. The macro matters. Are these popping up? Can someone give me a yay, nay on that? You do get them. Brilliant. Thank you, Jack. So there you go. So there we see. So I've shared a few things in there, but the blackout period, you can see the links. Brilliant. Thank you. So let me go to the blackout period in here from the Fed. So the Fed starts its blackout. It's basically 2 weekends before the meeting. So the meeting, if we go to the meeting we've got coming up, is the June 13th, 14th meeting. It runs till the Thursday after the meeting. So Thursday, we're still in blackout, yeah? But it starts 2 weekends before. So not this weekend coming, the 9th, 10th, but it's Saturday. It starts the Saturday before the meeting, okay? Sorry, there's 2 Saturdays before the meeting. So there's the meeting 13th, 14th, 1 Saturday before this Saturday coming the 10th, and then we have the 3rd. So from this Saturday, we're in blackout. So basically no Fed speakers as well. So we've got light data and no Fed speakers coming up. So it's going to be really markets just going with flow this week, and maybe keeping an eye on those 2 central bank events though, okay? I think that they could be important. See if we get because the RBA indicated, the Reserve Bank of Australia, that they might go on pause, and the market is expecting them to go on pause. We've got that coming overnight, so I'll talk about that quickly. And you can see in here data for today, though, 9:45 Eastern Time, S&P Global Composite and Service PMI. But more important than that, so that is significant, but more important really is the ISM data, which we have 15 minutes later at 10 o'clock Eastern. And we can't quite see it in there, so I'm probably going to have to go to tomorrow. There's the RBA. So midnight, 30 minutes past midnight, 12:30 in here, overnight tonight, the RBA. So if you're up and about, watching that, because they are expected to leave rates unchanged. They've been hiking. They indicated they will leave unchanged. There might be a surprise hike. So if they hike, that could be a signal that, that the global central banks are staying more hawkish. So maybe keeping an eye on that going through into tonight. What else do I have for you in here today? So that's what I've got, covering through the week ahead look. 5 things to start your day in here. So over the weekend, something that's not in the macro matters and wasn't in the calendar, wasn't in the weekly recap because it hadn't happened. It happened yesterday. Is that OPEC cut bigger than expecting in here, 1 million barrels a day cut in supply for July, and that's seen the oil price shoot up higher. So if I jump to the in here, we've seen a leap higher, so a big gap in oil. So there's a massive gap higher in here, made it to a multi-week high on oil. But look, going back, then tried to fill that gap. Didn't quite fill the gap, just left the gap slightly intact in here. This is on the July contract. Is that the right contract? I think that's, July contract in here. So the high there was from Friday, 72.17. We had a massive gap higher, tried to fill the gap, but just left a little bit of the gap in here, 72. So just left the gap, 72.17 to 72.25, nearly filled the gap and then bounced out of that gap. So, and the market kind of going right the way down, nearly filling the gap and then coming back out of the gap. So defending that gap in here. So that's one a piece of information in here from 5 things to start your day. In here, UK immigration curbs, boring, don't need to know that. US debt issuance. So obviously, whilst we've been going through the debt impasse, the debt ceiling impasse, okay, the US Treasury hasn't been able to issue debt, okay? And because it hasn't been able to issue debt in here, so I open this new tab in here, look, Biden bill signing set to unleash tsunami of US debt sales. So the Treasury is paying catch up. Look, expected to sell $1 trillion or more of new debt. And that is obviously going to put extra supply. Think about it just in basic demand and supply. We've had this pent up supply. We're going to get all this extra supply of debt, right? So excess supply of bonds, okay? What's it going to do to the price of bonds? Just basic, supply demand. Excess supply, a lot of supply comes in, pushes the price of bonds down, which pushes then yields up. And we're already starting to see maybe that happening now in here, is that initially, what is that stalled in here? So initially last week with the US debt ceiling being passed, we saw yields have been going higher because of concerns. So that's yields going up, bonds being sold. You don't want to hold bonds if they're going to default on the bonds, right? Then here, US yields going lower. Okay, relief. They've passed it. Okay, and now yields going back higher in here because we've got this, to use the words here, tsunami of debt issuance, and that tsunami of debt issuance in here, down in supply, pushes extra supply down in price, up in yields, and jumping back again in here to the bond market in here. There you go. So in here, big sell off in here Friday, and again in here, and then but part of the sell off on Friday in here is because of the US employment report as well in here, pushing bond prices lower as equities were seen as we go into risk on. That's a natural reaction to risk on, sell bonds in here. So we certainly saw that. What else do we have in here on 5 things? US debt, Credit Suisse, talent, not really interesting. European stocks, boring in here, nothing in there. Biden, we've already spoken about that. Sorry about that. So there's oil prices rise. We looked at the chart already. Oil prices climb, Saudi cuts. But a little bit of a focus on the data we've had through this morning in here. So going back in here to today, in here. Sorry, guys, just bear with me. So going back for the data today, you can see in here, look, all red. Yeah, European and UK European data all red in here on the composite and services PMI, all quite negative. And even though the UK was positive in here, we actually saw the prices paid data was higher, so actually putting upward pressures on prices. So that was actually negative in here. So all of that, and there's a whole string of articles in here I can just run through. Eurozone producer prices down, so that's a positive. Euro PP producer price index down for the Eurozone. But look, higher wage costs force UK service firms to push up prices. That's a negative for the UK, even though the PMI was good in here. Eurozone business growth slowed in factory May as factories struggled. Again, looking at that PMI data, Eurozone investor mood darkens due to problem child Germany. We spoke about German slowdown in here, and then but overnight in here, stocks have stayed firm. The Nikkei's up 2.2%. Hang Seng is up 0.84%. European stocks pretty much flat in here, although the FTSE is actually up 0.5%. But DAX, the German and in French indices in here, fairly unchanged. And if we look after that rip-roaring start in here on the Dow, 2% on Friday, S&P was up 1.45. I think the Nasdaq was only up about 1.5%, but kind of marking time on the futures in here overnight. A quick nod in here to the US futures in here, because I know that's what most of you are looking at. But I mean, I've got nothing more to say than staying bullish. I stayed bullish back on Friday in here. We've had this strong, just pop this one up and out. So S&P actually led the way in here. So on Friday, I'm going to, as you can see, multi-month highs in here, and a high level consolidation. It's like a flag pattern this morning. Go into the, I'm going into a 30-minute in here. There's the really strong bullish breakout after the data, and then just boom, just sitting there like a flag. And then, I think even if we just pop above like 42.93, it looks bullish there, even before it gets to the highs. And it's really the same story in the Nasdaq. Powerful Thursday and Friday, new highs, dip and a rebound, slightly more negative, but whilst above, support there, I would say minimally above 14,468, and Nasdaq looks positive in here. And you could probably just, you've got the little kind of trend line that runs across here on the overnight stuff. It's breaking this already, right? You got that one there that's already broken. You could redraw across to here, maybe off the peak there, or off of, or maybe off of there. But it's kind of sitting right there. I mean, I think Nasdaq up through 14,570, 580 looks kind of bullish as well. Really needs, it's only more negative down through there. As I say, that low from overnight is 14,468 and a quarter. So down through there looks a little bit more negative on a breakout. Okay. That's what I've got in here today. Any questions? Thank you for a little bit of interaction today, guys. Thank you for the hellos. Any questions? More than happy to answer anything related to markets, that is. No questions. Do you ever consider volume and market profiling? I do, Jim. Yeah, I mean, you know what? I'm not a big. I in my own personal trading on the volume, no. On market profile, I used to use market profile a lot. I do dip into it every now and then for value areas, but it's not something that I use a lot anymore. I mean, I actually tested market profile in its second incarnation for Pete Stadelmeyer back in the day. This is back in the when was that? That was early 2000s. So yeah, I have used market profile in the past. I dip into it every now and then with my analysis these days. Volume, I don't. I know a lot of people really love using volume. I find it very, very much as a secondary indicator, and I don't use it that much. I came in late. What does it mean? Futures muted. Muted just means little change. Muted. So there's been not much price action. Little has happened basically. So it's sort of sideways overnight. All right, guys, I'm going to wrap it up there. No more questions. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another bull versus bear webinar tomorrow. Until then, have a good one.